The Intelligent Investor by Ben Graham. So the other day I played poker for what was my first time. And I actually managed to win some money, which was really cool. I've often heard comparisons drawn between poker and investing. In both, you have this incomplete set of information and you're trying to make decisions based on it. So there's uncertainty, risk, there's reward, it's a zero-sum game. Yeah, there's a lot of similarities. But here's the difference between the two. So even being a complete amateur, because I had beginner's luck or whatever you want to call it, I managed to win that poker game that evening. But in investing, it doesn't quite work that way. So Graham differentiates between what he calls an enterprising investor and a defensive investor. And in today's terminology, that's basically an active or a passive investor. So the point that he makes is that if you want to be an active investor, you can be passive, that's cool too. But if you want to be an active investor, you cannot just bring a little extra skill to the table. Basically, you need to come with it if you want to be an active investor. And there's no middle ground. You can't have one foot in the active investor bathtub and the other out of the tub. You're either all the way in or you're out. So you have to make that decision. So when I first got interested in investing, I had this friend that I'd sometimes talk about investing with. And there was this one stock that I told him about. I said, hey, I'm interested in this. We talked about it. Cool. And then a few months went by, and then this stock started dropping in price. At first it was 10%, then 20, 30. It eventually fell 45% below where I'd invested in it. And I'd already read The Intelligent Investor by then, so I was somewhat aware of the idea that, stock prices are there to serve you. But even then, I had this guy whispering in my ear the whole time. Okay, not whispering because that would be weird, but I had him saying to me the whole time, like, geez, man, what's going on with this stock of yours? You're getting killed, blah, blah, blah. This is horrible. He would always say that. This is horrible. I'm like, man, stop saying that. Chill out. But Graham in this book talks about how you deal with market fluctuations in chapter 8. He uses the analogy of where you own a business, a private business. You have a 50% share in that business with this guy called Mr. Market. Mr. Market's a totally nice guy, but the thing about him is he's a little crazy. He's a little cray-cray. Sometimes he gets ridiculously optimistic, and at other times he gets really pessimistic about the business that you guys have. And Graham's point is that really he's there to serve you. If he offers to buy your share in the business at a sky-high price, way above what it's worth, then hey, that's to your advantage. You can take him up on that offer. On the same note, if he offers to buy your share in the business at a really low price that is not what it's worth, you're free to say no. And in stocks, it's the same idea. You don't have to say yes to you don't have to react to every stock price that is offered to you. Graham talks about two approaches to investing. In the first, you're trying to quite accurately predict what the company or the piece of real estate is going to earn in the future. You're basically banking on the future and that prediction. In the second, you see the future as something that you're trying to protect yourself against. So, because the future is unpredictable and, we're human, so we're going to have human error in our judgment, and there's always just unforeseen things that are going to happen, the future is something you should protect yourself against. And the way that you do this is through a margin of safety. That is, you buy at a price low enough, so it's so low or it's low enough that things can still go wrong and you'll earn a good return. So you can be a little off in your estimates and you'll still do perfectly fine. The final really cool idea from this book is that stocks are fractional ownerships in businesses. So they're not just tickers that move up and down on, your web page. There's a real business behind that stock, and that's how you should approach it. Approach it from a business perspective. So if you can do that, invest with a margin of safety and not get influenced by Mr. Market, but have Mr. Market work for you, then you can invest like an intelligent investor.